Welcome to Markets Now. I'm Michelle Rook along with Mark Schultz, North Star Commodity. Well, we ended mostly higher on Friday, except for portions of the wheat complex. And Mark, let's talk a little bit about row crops. Little dead cat bounce on Friday, but this market took out a lot of weather and war premium here this week, didn't we?
Yeah, we sure did. We've seen quite a fall in these markets. Wheat leading the way. I think Kansas City wheat some $1.70 a bushel off just from where the highs were just 9 days ago. So that's quite a washout. The corn market following suit as the wheat pulls it down because neither one has any export business to speak of for the time being. So the corn market also down sharply. Got a little bit of a dead cat bounce on the markets on Friday for the corn, just maybe some short covering just on ideas of nervousness going through, because you have two things. One, you never know whether there'll be another strike against a Russian port by the Ukraine forces. And or the rainfall, which has well been documented that there could be as much as 1 to 2, 1 to 3 inches of rain moving across the upper Midwest. And that, quite frankly, is about the only dry area that's left right now here for the crop is the upper Midwest. So you take some of the premium out, take a little bit, but nonetheless, still pretty big sell-off for those two. The soybeans held pretty good for the most part, but also they broke below some short-term support, which is up at 13.65 on November beans. They're now going to have the support down at about 13 to 13.18. If we start going below that, well, then we got a bigger sell-off on our way.
Yeah. So to your point, soybeans down 49 cents in the November, D's corn down 33, and wheat anywhere from 70 to over $1 lower for the week. And wheat kind of took down the corn market, kind of almost take no prisoners. It was kind of how it felt. So,
yeah, I think, and when it starts, it's tumble down. Like I say, when you don't have demand underneath the market, it's easier for the funds to be aggressive on the sell side. And the reason for that, there's nobody buying the dip on the market for the commercials. I mean, the only one making some money in here too are two of them, and that's the ethanol and the cattle guy. Otherwise, everybody else in the industry is just going hand to mouth and buying their feed needs at the present time.
When you look at that Russia-Ukraine situation, though, Mark, really, we've got grain that is moving out of Ukraine despite all of the attempts by the Russian military to shut things down there. And so as long as grain is moving somewhere in the Black Sea, it's going to be hard to get this market to pop, isn't it?
You're absolutely right. It's not that it's shut off completely. It's just being slowed down, but eventually, slowly but surely trickles out. The other thing that does happen is that the cost of that buying that Ukrainian corn and or beans and or wheat gets a little bit more expensive because the freight to get it down now to the Danube River is far more than what it was just to go out in Odessa. So that's the problem that they have. But like I said, what has been the fly in the ointment has been the fact that Russia flips around and says, we will now sell all of our products at a very steep discount to make up for the difference that you can't buy the grain from Ukraine. And that's what basically has hurt the market for the time being.
Yeah. I also talked about removing weather premiums. So let's talk about this rain event that we're forecasted to get over the weekend. All right, Sunday night we come in, we've had good rains. How much more do corn and beans go down versus if there is kind of a mess?
Okay, if we get the rains, and I think for right now, my observation would be the forecast is 1 to 2, 1 to 3 inches of rain across the upper Midwest. The dry areas are maybe 20% of South Dakota, probably 40% of Minnesota, and I'd say 60% of Iowa. And then you got maybe 20% in the state of Illinois. Everybody else is in pretty good shape. The thing you have right now is you've got cooler temperatures coming our way. So that's number one. If you want to have a big crop, it's below normal temperatures and above normal precip for the month of August. And so we got plenty of time in which to get some rain. Last year, we didn't see the rains really start coming in a big way until around the 20th of August. And then we started seeing 2, 3, 4, 5, 6 inches of rain for the month of August, and it all came at the very end, and the crop turned around and turned out to be very good. So there's still time to help this out. If you get an inch of rain, it might not be the best that we have unless the extended forecast goes warm and dry. That's the way it's going to have to be to get something on the bullish side. But for right now, if you get 1 to 3 inches of rain, they're good for a while in here, and even could get more rain at the end of August, and they'll be just fine. They get the crop would get bigger, not smaller. So in answer to that, I would say you'd watch that $4.80 on D's corn. That's the low. I'd like to think that that can still hold, but that would be the first obstacle to take out. If you take that out on the big picture, you could go down as low as $4.20 a bushel. And on the beans, they're going to find the support at 13 to 13. 15, 13, 18 is going to be their short-term support level. And the wheat is just flat out in trouble here for the short term.
Yeah, absolutely. Okay, let's talk about the cattle market. We had higher weekly closes there. Nice close on Friday. A lot of that was just predicated on higher cash trade. As you and I talked, the North has traded some higher cash. We haven't had much out of the South, though, right?
Yeah, there wasn't much trading, but what has traded thus far up into Friday here looks like it's going to be about $1 higher than a week ago. And
Yeah.
here's the thing that continues to be the case, and that is the cash market is still trading at a premium to the futures, and the futures just simply get pulled up with the market. So I've always liked the alignment. It's been good. I thought we would be in probably one of our worst months of demand, which is usually August and into September, and then things start to get a little bit better after that. I also thought we would see higher prices at the grocery store. Quite frankly, I didn't see that happen at the present time, so that we're getting by on that. We've slowed down a little bit. Exports this week were a little bit on the light side, but when you look at total beef production, we're down another 5.8% less for the week on beef production versus a year ago, and year to date it's 4.8% less. And you look up into Canada, they're basically the same, 4 to 5% less beef production on a year to date up there. So it's not like we're finding beef someplace else either. So demand's maybe held up maybe a little better than I expected in here. And nonetheless, the cattle market still performs very nicely. And for the technical side, you posted an outside up week on the cattle, which is a friendly signal.
You bet. A higher weekly close there. I was going to just mention that, and hopefully we can build on that. You mentioned the number of head that we have been killing here, and really some of it's a little artificial, isn't it? Because the Packers have been cutting kills to try to prop up the box beef margins, haven't they?
Yeah, the Packers attempting. I mean, he's been slow at trying to do his kill. His profit margins are about $65, $70 per head in the red. So he's trying to slow things down a little bit. But nonetheless, when you look at back of where we were, everybody basically was forecasting that even the USDA that we could be down as much as 6 to 7% less beef production when we get to the fourth quarter. We're not even to the fourth quarter, and we're already starting to knock on the door to get up to that 6 and 7% less on a weekly basis. So that's kind of the thing that I'm seeing. And basically, my whole dilemma on this has been on the demand side. And quite frankly, my surprise so far has been, even with sharply higher beef prices, we're still seeing the demand hold respectable.
Yeah. So we talked about a higher week for cattle. We had a lower week for the hogs, and we haven't seen that for a while. So is that going to confirm a seasonal top here? Or do you think the fact that we have these big discounts means that we have a little upside yet?
Yeah, my opinion has been that the discount has some ability to still go higher. We are at the time when pork cutout historically peaks out and we get a correction back down. I think that is probably in the works right now. Some of the primal cuts got very expensive very quickly, mainly the bellies, which jumped all the way up from $80 to $235. They're overvalued right now. Hams are at a respectable price, but you look at the other primal cuts of the ribs and the butts and the loins, they're closer to their buy zone than they are to the sell zone. So I think we balanced this pretty good. I expect the belly market to fall. That should bring the cutouts down some. But the same thing, what the hog market looks like is like the cattle. The cash in the cutouts are trading at a pretty good premium to the futures. And therefore, I think the downside of the futures is a little bit limited. I'm also hitching my wagon pretty strong on the spread between cattle and hogs. And December cattle trading over December hogs at $112 is all-time record highs.
Yeah, that's huge. All right. Thanks for joining us, Mark Schultz with North Star Commodity. That is Markets Now.